Welcome back to Investing Talk podcast.
Today, we're looking at Duolingo.
As usual, before we start, subscribe, like, and comment to this video to support the show.
And support is definitely something investors of this stock might feel like they need today.
Yeah, no kidding. Let's just get right into it because we sort of have a crisis on our hands. Or, well, at least that's what the market seems to think.
It's been brutal.
Right. If you've looked at your portfolio in the last 12 hours, we're recording this on Friday, February 27th, 2026, by the way.
Yeah.
You are probably seeing a lot of red next to that little green owl.
A whole lot of red. The stock tumbled between 22% and 22.9% in after-hours trading just yesterday.
It's a violent move. Violent is really the only word for it.
Absolutely.
I mean, we are talking about nearly a quarter of the company's value just vanishing overnight. And the thing I'm really struggling to wrap my head around here is that they actually beat earnings.
They did.
How does a company beat expectations and still get absolutely crushed like this? It feels, honestly, it feels like the market is acting completely irrational.
It certainly feels that way on the surface. But, this is a classic case of short-term pain for long-term gain.
Okay.
Or perhaps more accurately, it's short-term panic over a strategic pivot. Because if you look past the stock price today and look at the actual underlying business, the headline numbers from Q4 2025 are, well, they're impressive.
Let's hear them.
Revenue came in at $282.9 million. That is up 35% year over year.
35%. I mean, that is robust growth. For a company of this size to still be compounding at that rate is nothing to sneeze at.
It really isn't. And even more significantly, their bookings crossed the $1 billion threshold for the very first time.
Wow. Okay, I want to pause on that distinction really quick because we throw these terms around a lot. Revenue versus bookings.
Right.
For everyone listening, why does hitting $1 billion in bookings actually matter more than the revenue number right now?
It's a great question. So revenue is what they can legally recognize on the books for services they've delivered right now.
Okay.
But bookings represents the cash committed by users. Think of it like subscriptions paid upfront for the entire year.
Got it.
When bookings hit $1 billion, it means the cash engine is incredibly strong. It's a leading indicator of future revenue. It tells us that people aren't just trying the app out for a month. They are fully committing to the platform.
So you've got billion-dollar bookings, 35% revenue growth, and yet the stock drops 22%. There has to be a but coming. What is the catch here?
There is a but, and it's a big one. The central tension here is between what Wall Street wants right now, which is predictable, linear earnings beats, and what the company's actually doing.
Which is what?
They are pivoting to an incredibly aggressive goal. They've set their sights on reaching 100 million users, and they are using AI to get there. The market is basically punishing a weak guidance outlook, while the company is saying, hey, we are building a rocket ship. Stop worrying about the fuel costs for the next 3 months.
Okay, that makes sense. Let's transition over to the fundamentals of that financial health and this rocket ship idea.
Sure.
Because if the engine is sputtering, it doesn't matter where you're trying to go. You mentioned the bookings, but let's look at the growth trajectory. Is the user base actually expanding, or are they just squeezing more money out of the same people?
Oh, the user base is absolutely exploding. The company just hit 50 million daily active users, or DAUs.
50 million every single day.
Every day. That is a massive amount of people logging in to learn a language. But here is the statistic that really matters, and frankly, I think it's the most important number in this entire earnings report.
Lay it on me.
51% of that user growth was driven specifically by their new AI strategies.
Over half. So the AI stuff isn't just a marketing gimmick for them. It's actually driving the adoption.
Exactly. It is the engine now. It moved from being a nice-to-have feature to being the core driver of their acquisition strategy.
But here's where I have to play the skeptic for a minute. You have all this growth, you have the AI working, but then they issue guidance for Q1 2026.
Right.
And they projected revenue of $288.5 million. Now, for the listener who doesn't have the analyst spreadsheet sitting right in front of them, that number came in 0.9% below analyst estimates.
Less than 1%.
Less than 1%. And the stock drops 22%. That seems entirely disproportionate. It sounds like the market is terrified of something else entirely. Is the valuation just too high?
Well, it's partly valuation, but mostly the market just hates uncertainty. When a high-growth company like this misses guidance, even by a tiny fraction, it triggers this primal fear that the growth story is slowing down.
A crack in the armor.
Exactly. But the reason for that miss is because management is making a conscious choice here. They are prioritizing user acquisition over maximizing near-term profit. They are actively spending money to get to that 100 million user mark by 2028.
So they are sacrificing the present for the future.
Precisely. And if we dig into why they are so confident they can do that, we have to talk about the AI revolution happening inside the company, because this isn't just about slapping a chatbot on the app.
Yeah, I definitely want to drill down on this because every company says they are an AI company now. It's the buzzword of the decade. What are they actually doing that is different?
Let's look at the consumer-facing side first. They have new features like Video Call with Lily. This is available on their super tier.
Lily is the purple-haired emo character, right? The one who looks like she would rather be literally anywhere else than helping you learn French.
That's the one. She's sarcastic, she's unimpressed, and she's a huge fan favorite. Now you can actually have a video call with her to practice conversation.
That's pretty clever.
It is, because it simulates a real interaction with a distinct personality, not just a generic robot voice. And then there is Duolingo Max, which is their highest tier, powered directly by GPT-4.
Which gives you things like role-play scenarios and detailed explanations of exactly why you got an answer wrong.
Right. But here is the part that I find most fascinating. And it's not the stuff the user actually sees. It is the back end, the operational efficiency.
Okay, how so?
Because of AI, they have increased their content creation capacity tenfold.
Tenfold? You mean 10x?
10x. Think about what that means for a content business. They created 148 new language courses in a matter of months.
That is insane.
That is a volume of work that previously would have taken them decades to produce manually.
Decades versus months. That is difficult to even comprehend from a business scaling perspective.
It changes the economics of the business entirely. It allows them to expand rapidly into new verticals, like math and music, without needing an absolute army of content writers. They are scaling, but their costs aren't scaling at the same rate.
Which should, in theory, be amazing for margins. If you can produce the product for pennies on the dollar compared to last year, that profit should eventually show up.
And it is showing up. Profit margins are expanding because AI is driving down the cost of content creation.
Yeah.
This is the textbook definition of operating leverage.
So let's look at the balance sheet then. If they are spending on growth, are they burning cash? Is there any risk of them running out of runway here?
No, and that's the other crucial pillar. The balance sheet is squeaky clean. There is no significant debt. They are generating cash.
And they must feel pretty good about it too, because I saw they made a major move right after the earnings dropped.
The buyback. The board authorized a new $400 million share repurchase program immediately following the Q4 results.
That is a very loud signal to the market.
It's management shouting from the rooftops. When a company authorizes a buyback of that size right after a stock drop, they are telling you point blank, we believe our stock is undervalued, the market is wrong, and we are going to buy our own shares at a massive discount.
It's definitely a huge vote of confidence. So they have the cash, they have the AI engine running at 10x, and they have this strategic goal, 100 million DAUs by 2028.
That is their North Star. Everything they are doing, the conservative guidance, the spending, is all calibrated to hit that specific number.
All right, let's pivot to the technicals. We really need to make sense of this crash from a chart perspective, because for a trader, or really anyone looking for an entry point, a 22% drop is very eye-catching.
It is a massive dislocation.
So we have this drop on February 26. It suggests a gap down and extremely high volatility. When you see a move like that, is the falling knife catchable? Or do you just stand back and let the dust settle?
It's always tricky, but there is a technical term for what we might be seeing here, a capitulation low.
Explain that for the listeners.
Basically means that everyone who is even thinking about selling has panic sold. The sellers are completely exhausted. It creates a psychological state where the stock is fundamentally oversold. It clears out all the weak hands.
And usually that is where you start to see a bottom form.
Potentially, yes. And we have to look at the volume to confirm that. There was significantly increased volume in after-hours trading. People were dumping it, sure, but someone was on the other side buying it.
And we know at least one entity that is going to be buying heavily, the company itself.
Exactly. That $400 million buyback acts as a literal floor. It provides structural support for the price. Institutional support should kick in at these lower levels because the valuation has suddenly become so much more attractive.
Makes sense.
If the user growth story holds up, this sets up a classic scenario for higher lows moving forward.
So the floor might actually be in thanks to the company's own checkbook. Let's move to sentiment. What is the market mood right now? Aside from the retail panic selling, what are the smart money signals saying?
Surprisingly, the overall sentiment is technically neutral right now. It's very much a wait-and-see attitude. The headline sentiment score is just a flat 0.
That's surprisingly calm, given the violent price action we just saw. Usually, a 20% drop screams deeply bearish.
Well, it's a conflict of data. The Q4 beats on revenue, bookings, and DAUs, those were all fantastic. But they are completely overshadowed by that slight guidance miss. The market is paralyzed between the past performance and the future guidance. The trading algorithms honestly don't know which signal to prioritize right now.
What about the big players? The institutions, are they running for the exits?
Not necessarily. We've actually seen signs of institutional interest. For example, the Artisan Global Discovery Fund was referenced in recent 13F contexts regarding the stock.
Oh, the big funds are definitely looking at this level.
They are. And again, I just keep coming back to the buyback. That is the strongest signal of insider and institutional confidence in the long-term value. You simply do not buy back $400 million of your own stock if you think your business model is broken.
Very true. So looking ahead on the calendar, if I'm holding this stock, what dates do I need to circle in red?
The next big test is Q1 2026 earnings, which are expected in late May 2026.
That feels like a long time to wait in this kind of market.
It is, which means we might see some sideways chop and volatility in between. But what you need to watch during that next report is the user growth versus bookings trade-off.
And the market will be testing them on that.
Heavily. They're actually getting the mass users they promised. And keep an eye out for news on expanding the Lily video call access or any international acceleration. Those are the specific catalysts that can move the needle before May.
Okay, we have to play devil's advocate now. Time to look at the bear case. Let's transition over to the risks and figure out why the skeptics might actually be right. Why did the stock really drop 22%?
It's a totally fair question. We can't just ignore the fear in the market.
The primary fear, as I see it, is the law of large numbers. They're chasing 100 million users. As you get bigger, it naturally gets harder to grow at the same percentage rate. A 0.9% miss on guidance, causing a 22% drop, shows the market is incredibly fragile on this name.
It does.
Is the lifetime value, the LTV, of these users flattening out as they chase mass adoption? Are they just scraping the bottom of the barrel and getting lower quality users?
That is the inherent risk of mass scale. You might get a lot more users, but they might pay less or quit the app sooner. However, the counterargument is that operational leverage we talked about earlier.
The 10x content speed.
Right. Because
Yeah.
AI allows them to create content 10 times faster and significantly cheaper. They can actually afford to have users with a slightly lower LTV. The cost to serve those new users has dropped so dramatically.
So they can remain highly profitable even with quote-unquote cheaper users.
Exactly. The unit economics have fundamentally shifted thanks to the AI backend.
But speaking of AI, let's talk about the real elephant in the room. Risk number 2, the AI threat itself.
The total disruption risk.
Yeah. Why should I pay a premium subscription to learn Spanish when I can just open a free LLM and say, hey, teach me Spanish? Or just have a fluid conversation with it in real time? These free AI models are getting incredibly good. Doesn't that just completely erode their moat?
If learning a language was strictly about access to information, yes, the company would be dead in the water. But it's not.
Go on.
It's the gamified moat. People don't just want the raw grammar rules. They want the habit. They want the daily streak. They want the little owl getting angry at them for missing a day. They want the dopamine hit of leveling up and beating their friends on the leaderboard.
It's the gym membership versus buying dumbbells for your garage.
That is the perfect analogy.
Yeah.
You can lift weights at home for free, but people still pay $100 a month for the gym because of the environment, the structure, the classes. They blend AI with that gamification. Features like the roleplay and explain my answer are perfectly integrated into a highly addictive game loop that creates massive switching costs. Raw AI tools don't have the fun factor, and they don't have that streak that keeps you coming back for 300 days in a row.
That sticky engagement is really hard to replicate.
And honestly, the recent sell-off likely prices in this fear already. The market is discounting the stock, assuming AI will inevitably hurt them. But looking at the actual data, AI is actively helping them grow faster than ever.
It's a fascinating dynamic. They are using the very technology that supposedly threatens them to build an even bigger wall around their business.
That is the textbook definition of a brilliant defensive pivot.
All right, we've looked at the numbers, the technical damage, the sentiment, and the risks. It's time for the verdict. What is the final score here?
Taking absolutely everything into account, the severe overreaction to the guidance, the rock-solid fundamentals, and those massive AI efficiency gains, I am assigning a bullish score of 8 out of 10.
8 out of 10. That is high conviction. Give us the quick elevator pitch. Why does this belong in a portfolio today?
Here is the thesis. This is no longer just a language app. It is an AI-first company masquerading as a mobile app. The headline story isn't the earnings miss. It's the 10x content creation speed and the very clear path to 100 million DAUs by 2028. They have 50 million users right now, and they have an AI-driven roadmap to double that.
And from a pure value perspective,
The 22% post-earnings drop is a massive overreaction to highly conservative guidance. You have a company with over $1 billion in bookings, a pristine balance sheet, and they're buying back $400 million of their own stock.
so they're financially rock solid.
Absolutely. This is a rare chance to buy a premium, high-growth asset at a steep discount simply because the algorithmic market got spooked by a decimal point.
So what's the time horizon for a trade like this? This isn't just a quick flip, is it?
No, definitely not. This is a multi-year hold into that 100M DAU milestone. You're making a bet that management can execute on this ambitious 3-year plan.
That's the breakdown on Duolingo. If you enjoyed this analysis, hit that subscribe button and let us know in the comments, are you buying the dip or are you scared of the AI threat?
Thanks for tuning in, everyone.
We'll see you next time.